Good morning and welcome to Breakfast with Bev. Another Wednesday has rolled around and here we are again. I am Bev Curtis with Bev and Company at House of Brokers Realty, and I have the pleasure to be here this morning with Miss Kelly Walters with Black Branch Home Loans. Do you mind introducing yourself, Kelly?
Hi, I'm Kelly Walters. I'm a senior mortgage banker with Black Branch Home Loans.
And she is an expert when it comes to home loans and also in regard to credit. And so I don't know if you guys recall, but back on January 31st, we did a part one airing of something titled like Happy Homeowner, Happy Credit Score. So if you have a happy credit score, it probably means you're going to be a happy homeowner. And the thing that comes up a lot in real estate and just in all aspects of life is that credit, your credit score, the good, the bad, and the ugly, does follow you around throughout life, whether you want it to or not. It's one of those things you just really can't run away from. And so we've had lots of people through the years ask questions, and it seems like there is 5 questions that just comes up notoriously over and over again. And so I know Kelly is an expert when it comes to just analyzing credit reports, looking at credit scores. She's assisted a number of people through the years with credit repair and getting them to be a very happy homeowner. And so this morning, I would like to visit with you, Kelly, about answering some of these questions that we've compiled that I think would be very beneficial to our consumers.
Great.
You ready?
Sounds good. Yes.
All right. So I'm going to fire off the questions and you tell us what your thoughts are. So here's one that comes about a lot. It says, what about credit monitoring services like Credit Karma? How accurate is Credit Karma's score versus a credit score when you pull it for a mortgage loan?
Right. Yes, so Credit Karma is a monitoring service that tells you what your score is whenever someone pulls your score, so you can kind of keep track of what's going on. But whenever someone pulls credit for the purpose of going into debt, there's a risk associated with it. So like a car loan or a credit card or mortgage inquiry, when I pull a credit score, it's usually going to be lower than what Credit Karma is telling you, only because there's a risk associated with it. The purpose for me pulling is to open a mortgage debt, and for Credit Karma, it's just, here's your score for the sake of what the data shows your score will be. But my score is always a few points lower, and folks just kind of, like, hey, what's going on with Credit Karma? And so it's just because of the reason of the inquiry is why that happens.
The reason for the inquiry. It seems like that kind of plays a part in credit in general.
Yes.
It seems like. Okay. So here's another one then. What if I'm shopping for a mortgage, but I'm worried about too many credit pulls? Because as people kind of shop around for rates and try to get competitive, is that going to ding my score?
Right. So, well, yes, but when you are shopping for a mortgage loan, it's very common for folks to shop 1, 2, 3 places, maybe 4, but you can have up to 3 or 4 credit inquiries, mortgage related, in a short period of time, like 2 weeks or a month, and it really not harm your credit. Because so I would pull your credit and maybe another lending institution pulled it 10 days earlier. As long as nothing else is going on in your credit life, I should be able to see the same data they did and the same score, because it's a mortgage related inquiry. Whereas if you pulled, had maybe 3 credit inquiries for a credit card, like a store card, or just open up an online credit card, with today's technology, you could actually open up all 3 credit cards from 3 inquiries and actually use the card number and have a balance before the credit bureaus know that you have a balance and a payment. So they assess risk and they adjust downward. They're like, okay, this person has 3 credit card inquiries, something's going on, they need credit, maybe they need money. So we don't know, we're going to assess the risk and drop your score like substantially with each credit card related inquiry. But 3 mortgage related inquiries, I mean, honestly, you're only going to end up with 1 mortgage loan. So the credit bureaus know to assess that risk that you're just shopping. And the credit inquiry is coded by who pulls it. They know this is a retail related credit inquiry for a card, or this is a mortgage related finance company looking at mortgage lending. So
would that be kind of considered more of a soft pull when it's kind of
Not necessarily.
Okay, not necessarily. Okay.
Yeah, so there's two types of credit pulls or inquiries, the soft inquiry and the hard inquiry. When I pull your credit, it's for the purpose of going into a debt. It's a hard inquiry.
Okay.
When someone pulls your credit, like say for a service, like a utility or Dish Network, your car insurance company, every few years they pull credit to see what your score is doing. That's a soft inquiry. You don't even know what happens behind the scenes. It doesn't affect your score at all. Or if you get like the pre-approved credit card in the mail, like, congrats, you're approved for a $1,000 credit card. That's the result of a soft pull, because they want to know, hey, is this person someone we want to have our credit card? It goes on behind the scenes. You may not even know it happens.
Gotcha.
But when someone pulls your credit, a hard inquiry, it's to go into debt, like a car loan, a car dealer, or
big time debt.
Yeah, it is different than just a service. Yeah.
Okay. So, and that kind of leads into the next one, and you kind of already answered that, is there a difference between pulling my credit for like a car loan versus a utility hookup? Right. And you've kind of already addressed that. So, okay, so that takes care of that. So here's the next one that's always interesting is, what if, I mean, there's a lot of diligent folks out there that really don't want to have revolving credit, and they like to pay cash, and they like that debt-free feeling. What if somebody comes in and has zero credit? I mean, someone either coming out of school or just someone that believes in paying cash and not operating on a line of credit. What then?
And that's a very common question. It's a good thing. A zero credit score borrower is not a bad thing. There are options. But unfortunately, in the world we live in, with the industry, the mortgage lending industry, the credit score is the best number that we have to assess risk at how well someone pays their financial obligations. So when you're a zero credit score borrower, you're kind of off the radar. You pay for cash. You pay for things in cash. Or you're young and you're just starting out. So a zero credit score borrower, the options they would have, generally what we would look at is non-traditional credit, things like a rent reference. If you've rented somewhere with a lease in your name for 12 months and satisfactorily, you have what we call a trade line. You have an account that's a non-traditional credit. Non-traditional just means they don't report it to the credit bureaus. Things like car insurance. If you're a young person in college or out of college, the car insurance would need to be in your name only and pay it for 12 months. There's your second non-traditional credit source. Things like cell phone bill, utility, all these things, we can build a credit profile and see how well you pay. It's just non-traditional. But it remains to be said that some loan programs do require a credit score. And if you have a zero score, you may not get as good of an interest rate as someone who has a score. So if that's the case, there are ways to build credit in a relatively short amount of time without going into debt, without paying fees and interest. Like, we can explain that to you and show you how to do that. And probably 90 to 120 days, you can have a score without paying any interest, without going into debt. If that's important to you, like you just don't believe in debt, we can still help you.
Okay, very good. And then the other thing is then, what if a person maybe is in some financial difficulty? Lots of times, I mean, life just happens. Right. And, or there could be a medical situation or whatever might come their way. What would you suggest as far as like consumer credit counseling goes if I'm in kind of a tough situation and want to try to find my way out of it? Would you recommend going to a credit repair expert? Or like someone in a law firm that specializes in credit repair? What's your thoughts on that?
Well, two things there. The consumer debt counseling or credit consolidation companies, there's a lot of different terms that are used interchangeably. They can be very helpful to someone who just has a goal to get out of debt, or if they have a lot of debt that they know they cannot pay off themselves in a timely manner. So a consumer debt consolidation company would kind of be an advocate, come along beside you and negotiate with those credit card companies or whatever to take away some of the interest, to take a lesser payment so that you can get on a plan and a goal. And what they do is they take all your accounts, you pay one payment to the debt consolidation company, and then they divvy it up to the creditors. And so you really got to go into it with eyes wide open, because it's not to say some are good or bad. It's just the way that the credit reporting data ends up occurring. And then the creditors that you've negotiated with, like say you have a credit card payment that's $100 minimum payment, and when you enter the debt consolidation program, they may agree with this company to take less, like $75 instead. But what you may not know is they still reserve the right that every month they don't get a full payment, they can report a late payment to your credit report. So you may have this goal in mind, and 24 months into this plan, and you've got your stuff paid down, and you go look at your credit, and you see you've got you have 24 30-day lates in a row. So you accomplished one thing, but what you have to realize is you just need to go into it eyes wide open, make a plan. Say you want to buy a home in 3 years. It may be 5 years by the time this debt consolidation company, does what it needs to do. So it can be a good thing. You just need to really be prepared when you go into it. And then if it's just so far along that, we're not credit repair experts.
Right.
We're not going to guarantee a minimum increase in your score, but a law firm or a credit repair company can enter an agreement with you to you pay a monthly fee or a lump sum. And if they can't increase your score by a certain number of points, I know there's terms where they might refund some of your fees. Sometimes it's so far gone that we can't really, there's a lot of things, identity theft or really large things that are just wrongly reporting. That's when you need an expert, like a lawyer. This is all they do. They know the laws. They know they can send off letters. They can dispute items and remove items. And we have several companies. I mean, we have state offices all over the state and in several other states. So there's a lot of companies we've kind of accumulated people that have contacts with that really have some good results for consumers. That's what we would recommend.
That's great information to know. Because for a homeowner today then, it's probably beneficial just to talk to a lender well in advance before even thinking about purchasing, just to know what your options are, kind of where your credit score falls, if there's anything that you could do differently in the meantime, kind of that preparing stage, would you not say?
I would agree, because we're in a rising interest rate environment right now. And so someone who is already a homeowner, maybe they're thinking about moving up, and they pay their bills on time, they think everything's fine. They may not realize that, 740 and above for pretty much all the lenders, especially locally and online, that's usually the best tier to be in for the best interest rate. So you may pay your bills on time. You may not realize that the balance you carry on your credit card compared to the limit can make you have a lower score on a particular day of the month, and you don't know it. And you may think, okay, I'm going to buy a home in the next 3 months, and your score be, 689 or 702. And then you realize, wow, okay, what can I do in the next 30 to 60 days just to bump me up? And again, not that we guarantee anything, we just see some best practices and tips that people kind of implement. And in the past, other consumers have been successful at bumping their score up, 10, 20 points. And
I have a question for you too, and I don't know if you know the answer to this. What about, I know other people have asked, and I have the question myself, how you go to a retail store and they always have these promotions that if you take out a credit card, you can save 15% today or 20% today. And, yeah, and it's just kind of it's so tempting, but then on the same flip side, it's I really don't want to have all these credit cards just lingering out there with all these open balances. So I typically decline them. I don't know if that's a good thing or bad thing. I mean, I could, it's probably costing me more money to do that. But if you've got some open lines of credit on credit cards that you've not used in a while, say a retail store card, would you recommend closing those out or just leaving them open? Because part of the thought process, I would think, is that, okay, if you have it open but you're not using it, it shows good diligence that you're not, overextending yourself or maxing it out. But then on the flip side, it's also the risk factor that you could go out and charge all of this up too. So I mean, is there a good rule of thumb on that?
Well,
and I'm not trying to put you on the spot. It's that's just a question.
It's a fine line between telling someone, hey, go ahead and close that card because you don't need it. Because generally speaking, closing credit cards can drop your score a little bit.
Really?
But
Even though you're doing it for the purpose of just cleaning it up?
Well, it depends on how, like, again, your whole credit profile over time, how many cards you have. So if you have like one main credit card that maybe you put things on, you pay it off every month, that's the active card. But you've got these 2 or 3 little scores, store credit cards over here. If you're generally not using them, sometimes they'll just close naturally because of inactivity.
Okay.
The creditor's like, okay, this is a 3-year-old card, it's stale and no one's using it, let's just cut it off. That's not necessarily going to harm you if you have a lot of other established credit over your credit profile. If you're someone that is your only card, or maybe you only have 2 cards and you have like a 15-month credit history and you're like, I don't need that card, I'm going to close it. What you do then is you limit your access to credit by closing the line. And so again, back, visiting what we talked about back in January, the credit bureau likes to see you have adequate access to credit, but that you only use about 30% of your credit limit. So when you limit your access by closing credit cards, theoretically, like, again, there's no magic formula to tell you, you do this, this will equal 5 points, good or bad. Generally speaking, closing it can hurt you. So if you were thinking about buying a home, generally speaking, do those kinds of things after the home closes, just to make sure your scores.
Well, and that's where talking to a lender ahead of time to know what to do before you do those things. Case by case. Everyone's different. Everybody's got unique situations. But I think the whole gist of the story here is that having a credit history and your credit report is certainly a very important aspect in your financial piece of life. And it does follow you around, and it is something that you do have to contend with on a regular basis. And it sounds like many times it's being used and you don't even really know that it's being used. So it's kind of a mystery, the whole credit score system and the reporting and all of that. So certainly seek the proper advice, either from a lender or from a consumer credit repair company or legal counsel. We're certainly not experts here, but today's topics were strictly just trying to address what are the topics that we see, what are the questions that come in that people have about their credit when they're looking to purchase a home. So that's kind of the whole idea of today's topic. So, well, thank you very much, Kelly, for joining us again today for our Part 2 series of this. I hope you find it very beneficial. I find it very fascinating because it's just kind of, like I said, it's one of those things that's kind of a mystery, but it's something that we all have to be very much aware of. So,
well, I love talking about it, so thanks for having me.
Yes, so if you are thinking about purchasing a home here in the near future, by all means, reach out to Kelly here at Flat Branch. So you would be in very good hands. And she obviously knows her stuff about credit, so she would take very good care of you. So thank you very much for joining in with us this morning, and we look very forward to seeing you next week. Enjoy the sunshine. Okay. You did great.
Thanks.
Man, you did great.